Well, let's now turn to the broader markets. We've got Fed officials now moving forward towards another rate hike of 0.75 percentage points at the November meeting. We've got Yahoo Finance's Jared Blikre, as always, on top of this, and yields certainly been the focus of the week. But yet again, today we're talking about a level we haven't seen in 14 years.
Yes, and let's go to the Wi-Fi Interactive. I'm plotting the U.S. dollar index. We're going to circle around to currencies in a second, because what we're talking about in terms of bonds very closely linked with currencies, and there are spillover effects into equities. Everything is linked here. So here's the U.S. dollar index, appreciated 17% versus this basket of currencies, mainly weighted towards the euro, but very illustrative of what's been going on here. Here's a 10-year T-note yield. It looks very similar to that U.S. dollar chart. In fact, they're very correlated, hitting 4.22%. Now, it has backed off a little bit higher number than that, but as you said, Akiko, most of these bond yields we have not seen since 2007 through 2011. I can show the 5-year, that's down 9 basis points. The 30-year, that is up 8 basis points. So we have a lot that's happening with the yield curve right now, and essentially it has been flattening. And let me just point you, I'm going to put the U.S. dollar one more time here, and I have some comments from Nordea that I want to go over, because we are caught in an effects loop here, and this has to do with the Bank of Japan. Now, Nordea is taking a look at this. Countries, they're saying, do not have an endless amount of U.S. dollars at disposal to sell, meaning that effects intervention will fail when the U.S. dollar coffers run dry. This is from the perspective of these central bankers. Over in Japan, they have amassed a war chest of U.S. dollars. They also hold $1.2 trillion in U.S. treasuries. Very important here. So Nordea going on to say, moreover, effects intervention involves selling U.S. treasuries. That's to get U.S. dollars, which adds upward pressure on U.S. rates. That's because rates are inverse to bond prices. Stick with me one more second here. This leads to a stronger U.S. dollar in isolation. This affects intervention U.S. dollar doom loop, illustrated here. I'll show you the picture in a second, could lead to dollar overshooting, especially when central banks are enforcing the loop. So here we go. Weaker yen, sales of U.S. treasuries, higher U.S. dollar rates, weaker yen, and the cycle continues. And that's what we've been seeing here. And the spillover effects, as I mentioned, with respect to equities, these deleveraging actions right here, we're not going to see a bid on equities until all of this is done. And the central bankers have been very flat-footed about the response so far.
Yeah, the BOJ in even tougher position given the data we got today, right? 8-year high inflation, not at the level that we're seeing in the U.S., but still, they've got a very dovish policy in place. They've got the yen continuing to weaken against the dollar, and then now they're looking at inflation.
We didn't get to it, but the yen very volatile today. Maybe an intervention that we don't know about going on right now.